Markets never sleep. Humans do. Okay, picture this. It's 3:17 in the morning. You are fast asleep, probably dreaming about something completely unrelated to finance. Meanwhile, over in the crypto markets, Bitcoin suddenly drops 8% out of nowhere. But right as that happens, a tiny piece of code recognizes the drop, buys the dip, and then turns around and sells it 2 minutes later for a tidy 2% profit. You wake up the next morning, make your coffee, and realize you completely missed the action. Except, that little piece of code, it just made your rent money while you were literally snoring. Welcome to this explainer. Today, we are going to tear right through the shiny, hyped-up exterior of AI trading bots and show you exactly what is going on under the hood. Because let's be real, for every flashy social media post showing some teenager buying a luxury car with bot profits, there are 100 blown-out, zero-balance accounts that nobody ever talks about. So we're going to strip away all the marketing jargon and look at the cold, hard mechanics of how these automated systems actually trade and what you absolutely need to know to survive out there. Okay, let's dive into this roadmap. First, we'll look at humans versus code. Then, we'll meet the bots. Third, we're heading into the engine room. Fourth, we'll run a crash test. And finally, we'll wrap up with the operator's manual. All right, kicking things off with Section 1, humans versus code. You know, human biology kinda hates making money in fast-moving markets. As humans, we are completely driven by emotion. We buy when social media is totally euphoric, and we panic sell the second our portfolio hits a 20% loss. Plus, we actually need to sleep, which means we miss that 3 a.m. pump entirely. And our math, well, trying to calculate 50 indicators across 20 different coins in a single second is literally impossible for a human brain. But a bot operates on one incredibly simple premise. If this, then that. It is completely emotionless. No hope, no fear, no whispering, well, maybe it'll bounce back. It just executes its programmed rules 24 hours a day, 7 days a week, doing instant math without breaking a sweat. And what's the actual cost of all that human emotion? Well, it's 97%. According to a massive study out of Berkeley, 97% of day traders lose money over time. The house always wins, right? And in trading, the house is emotion. But here is the absolute critical takeaway for us. Throwing a bot at a fundamentally bad trading strategy does not suddenly magically make you profitable. It just means you're going to lose your money much, much faster, 24/7. Bots win on strict discipline, not necessarily on high IQ. Moving right along to Section 2, meet the bots. First up in the showroom, we have the grid bot, or as our source brilliantly calls it, the casino dealer. Think of this bot like setting a trap in the woods. You give it a price range, say Bitcoin between $50,000 and $70,000. It just places buy orders every $500 down and sell orders every $500 up. It prints money when the market bounces sideways, acting exactly like the house at a casino, profiting off the back and forth volatility. But, and this is a massive but, it fails miserably if the market heavily trends in one direction. If a coin crashes, a grid bot is programmed to keep catching the falling knife. Just ask anyone who ran a grid bot on the crypto token Luna back in May 2022. The bot obediently bought that dip all the way down to absolute zero. Next up is the DCA bot, affectionately known as the boring millionaire. DCA stands for dollar cost averaging. This little guy just buys a fixed dollar amount of a coin on a regular schedule, completely ignoring whatever the current price is. It optimizes purely for long-term uptrends. I really want to highlight this one because it is hands down the safest, lowest stress option for like 90% of beginners. It's not flashy, it's not super exciting, but trust me, the real alpha in bot trading, it's patience. Then we have the penny pickers, arbitrage and market-making bots. These bots profit off microscopic price gaps between different exchanges or by earning the tiny spread between a buy and sell order. Now, while these bots do have a very real mathematical edge, there is a giant catch. Retail traders using small accounts will absolutely get eaten alive by transaction fees here. To make any meaningful money grabbing pennies off the floor, you need massive capital and institutional-level server speed. So these are strictly for the pros. Which brings us to the giant elephant in the room, the AI prediction bot. Let me just ask you this directly. If someone actually built an AI bot that genuinely mathematically guarantees a 1% daily return, why on earth are they renting it to you on the internet for $50 a month? They wouldn't. No way. They would run it quietly in their basement and go buy a private island. We really need to pop this bubble right now. Most commercial AI bots are not some conscious ChatGPT-like entity predicting the future. They are just basic machine learning models pattern matching past price data. Basically, they are selling you a shovel in the middle of a gold rush. Which naturally brings us to Section 3, the engine room. Now, what's really interesting here is looking at how a bot actually makes a decision. Let's walk through this mechanical pipeline. Step 1, data comes in. This is price, volume, maybe funding rates. Step 2, that data runs through indicators like the RSI or moving averages to generate a signal. Step 3, the bot checks its strategy rules. Is the RSI under 30? Yes. Step 4, it checks its risk sizing. Okay, only use 2% of the account. Step 5, execution via the exchange API. And here's the crazy part. The bot runs this exact sequence 10 times a second. It doesn't have a gut feeling. It doesn't read the morning news. It just follows this strict, unfeeling loop over and over again. Now, because bots are strictly rules-based, developers love to test them on past data. It's a process called backtesting. But let me warn you exactly why backtests lie. A backtest might show an incredible 5,000% return, but 80% of those same bots will completely fail in live trading. Why? Mostly because of overfitting. The bot basically memorizes the past. Like, it might notice a random buy signal right before the massive 2020 COVID crash, and then assumes that exact pattern is a universal law of physics forever. It's basically financial astrology. On top of that, backtests often conveniently pretend that trading fees and network lag, what we call slippage, just don't exist. They also suffer from survivorship bias, meaning they only test on coins that survived and didn't go bankrupt. Listen, if a backtest looks too good to be true, it absolutely 100% is. All right, it's time for a reality check in Section 4, the crash test. This is a rule you absolutely must engrave in your mind. Leverage plus a bot equals a liquidation speed run. Let me break down the math of this account killer for you. If your bot uses 10x leverage and the market suddenly drops just 10% against your position, your entire account is wiped out to zero. Poof, gone. Bots cannot call you up and ask for a margin top-up. They just keep executing blindly until your account is dead. This is exactly why beginners must strictly stick to spot trading. In spot, you literally can't be liquidated. The absolute worst-case scenario is that you just end up holding a bag of coins that have dropped in value. Next up is your digital security. To let a bot trade, you have to give it an API key connected to your exchange. So here is your non-negotiable API defense checklist. First, never, and I mean never, give a bot withdrawal permissions. If a service asks for it, it is a scam, full stop. Back in 2022, a huge platform called 3 Commas had an API leak. Now, hackers couldn't withdraw the money directly, but because users hadn't locked down their keys, the hackers counter-traded $22 million out of those accounts. You absolutely must enable IP whitelisting. Use a separate sub-account with limited funds, and for goodness sake, delete your keys when you're done using them. And hey, keep this quote in mind. If coins aren't in your wallet, they're an IOU. Even if your bot is running perfectly and making incredible profits, leaving all those profits sitting on an exchange is a massive risk. I mean, we all watched the FTX collapse, right? Traders had wildly successful bots running on FTX, but the second the exchange halted withdrawals, all those digital profits just vanished into thin air. Your bot's profits aren't actually real until you move them to cold storage, so make it a hard habit to withdraw your profits every single week. Let's wrap things up with an actionable survival guide in Section 5, the Operator's Manual. Here are your exact steps to go from zero to bot. Notice how highly structured this is. Step 1, you set up a sub-account. Step 2, you create a safe API key with 0 withdrawals. Step 3, connect your platform. But I really want to hammer heavily on Step 4. Paper trade for 30 days. Every major bot platform has a demo mode where the bot trades fake money using real live market data. Look, if your bot is not profitable with fake money after 30 days, it definitely, undoubtedly will not be profitable with real money. So, the crucial point here is the 1% rule. Never risk more than 1% of your total account on a single bot trade. Let's say you have a $10,000 account. Your absolute maximum loss per trade should be exactly $100, no exceptions. This means you must utilize a hard stop loss. Setting a rigid stop loss is literally the one thing that separates the long-term survivors from the permanent bag holders. And remember, at the end of the day, you are the boss, not the bot. You are the ultimate risk manager. So here is exactly when you need to step in and hit that kill switch. Turn the bot off during major news events like Fed meetings or inflation data releases. Bots don't watch the news, and sudden, wild volatility will cause massive slippage. Shut it down if there's even a rumor of an exchange hack. Shut it down if your overall losses exceed 20%. And honestly, shut it off if you look at the strategy one day and realize you no longer understand what the heck it's doing. So, we'll wrap up this explainer with one final provocative question. Are you ready to let the market pay you to be boring? Or will you end up feeding the bots? Remember, AI trading bots are not magic money printers. They are just unfeeling, relentless tools that amplify whatever strategy you hand them. If you respect the risks, start small, and manage your human emotions, these tools really can reward deep patience and strict discipline. Thanks so much for joining me today. Until next time, keep your APIs secure and your risk managed.